Hello everybody and welcome. My name is Sebastian and today we're going to be solving question 4 from the fall 2011 midterm, and it's going to focus on accounting for receivables and bad debts. So this is quite a long question, so we're going to start by reading everything off first and highlighting some important information. So let's get to it. The following events occurred at Pete Boilermaker Inc., hereafter Pete, from October 1st to December 31st, 2011. And we have a bunch of points. Sorry about that. So, A. On October 10th, Anthony Inc. called Pete and placed an order to purchase boilers. Now I'm going to make a small note here that says placed an order. That does not necessarily mean, does not equal mean that they bought the same order. Point B. Pete sold 15 boilers to Bianca Corp on credit. And I'm just going to highlight that, and we 15 to Bianca. November 1st, the purchasing manager of Anthony Inc. visited Pete and purchased 12 boilers instead of the 15 boilers that were previously ordered. So this will be important when we're looking at our journal entries. C. Looking at D, Bianca Corp paid for the boilers purchased on October 30th in full. Next, E. On November 7th, Pete sold 10 boilers to Cheng Limited on credit. F. November 15th, Anthony returned 2 defective boilers, and paid the amount due to Pete. G. On December 1st, Cheng paid $80,000 to Pete on account. December 5th. After a thorough review of its trade receivables, Pete determined that receivables totaling $12,000 were not collectible. These receivables relate to sales made prior to October 1st, 2011. A write-off was recorded on the same day. Finally, I. On December 30th, Pete recovered $3,000 from the receivables that were written off on December 5th. And it's a lot of information, but we'll break it down later. Let's look at some additional information. Pete sold all boilers at $10,000 per unit. So all boilers, $10,000 per unit. All of Pete's sales were on credit with terms 310 and 30. So this means, I'm really bad at using this, this means that if paid within 10 days, customers get a 3% discount. The rest should be paid within 30 days, and that's the full amount. Next, we see here that Pete's records include the following items and their balances at September 30th. So it's important to note that everything we read before is only from October forward. There are a lot of things that happened during September that we need to take into account, which is right here. Trade receivables, AFDA, allowance for doubtful accounts, and net sales. Finally, Pete had not yet recorded any amount for bad debt expense, and Pete uses the periodic inventory method. Now let's quickly read through the required, and after that we'll get started. Required number 1. Pete prepared the journal entries to record the transactions in D, F, H, and I. Next, Pete uses the age of trading receivables method to determine the amount of bad debt expense according to the following schedule. So not yet due, 130 days past, 31 to 60, and more than 60 days. And these are the rates that are applied to receivables in each age category. And in requirement 2, they want us to determine the amount of receivables that may not be collectible in the future and prepare the journal entry to record bad debt expense on December 31st, 2011. Obviously, as always, show your calculations. And there's an important hint. You may wish to use a timeline, and we will use one. We'll use multiple timelines to keep track of trade receivables in order to determine the age of these receivables. Next, we're not quite done yet. Requirement number 3. Assume for this part only that Pete uses the percentage of credit sales. I'm going to have that, actually, it's important. method to determine bad debt expense. Based on past experience, Pete estimated the bad debt rate to be 1% of net credit sales. Determine the amount of bad debt expense for 2011. A journal entry is not required. 4. Pete's net trade receivables were $62,000 at December 31st, 2010. Calculate Pete's average collection period for the year 2011 and explain what it means. Assume that Pete uses the age of trade receivables method for this requirement. And the last but not least, 5. Evaluate Pete's average collection period, knowing that two major competitors, Spartans Corp. And Hosier Limited, reported average collection periods of 20.3 days and 30.7 days, respectively. So we're going to evaluate and compare their ratios. So now that we've read the whole question and all the requirements, let's get started. There is a lot of information, but we'll work through all of it slowly. So let's start with requirement 1. Prepare the journal entries to record the transactions in D, F, H, and I. So we're going to go up here and single these out. So we want to take a look at D, we want to take a look at F, and we want to take a look at H, and finally we want to take a look at I. Now before we get started, I'm actually going to recommend that we draw ourselves a timeline to be able to look and see what happened when. So just 2 seconds, and then we'll get started with that. All right, let's get started with our problem solving. So as mentioned, we're going to draw a full timeline of everything that's happened because there is quite a bit of information. I always recommend to draw timelines when we're dealing with a complex schedule. So if we look at A, on October 10th, Anthony called Pete Inc. and placed an order to purchase 15 boilers. But there was no actual purchase, there was no actual payment. So over here, we actually don't really care too much. October 30th. On October 30th, Pete sold 15 boilers to Bianca on credit, so on account. November 1st. On November 1st, the purchasing manager of Anthony Inc. visited Pete and purchased, so they sold 12 boilers to Anthony. Now, it's not mentioned if it was on account or not, so for now, we're going to assume that it was on account because it was previously said all of the sales were. On November 5th, Bianca Corp paid for the boilers purchased on October 30th in full. So Bianca paid in full for 15 boilers. Perfect. Next, we move on to November 7th. On November 7th, Pete sold 10 more boilers to Cheng Limited on credit, so on account. On account, perfect. Next up, we have December 1st. On December 1st, Cheng paid $80,000. Beautiful. Almost there. On December 5th, after a thorough review of its trade receivables, Pete determined that receivables totaling trade receivables, $12,000, were not collectible. These receivables related to sales made prior to October 1st, 2011. A write-off was recorded on the same day. So trade receivables of $12,000, write-off from before October 1st sales. And that's a long one. And finally, on December 30th, we see that Pete recovered $3,000 from its December 5th write-off. Now, I know it's very tight and there's a lot of information, but it'll be really helpful moving forward. So we were asked to create journal entries for D, F, H, and I. So let's get started. Looking at D. D tells us that Bianca Corp paid for the boilers purchased on October 10th in full. And this is why the timeline is very, very important. So we're saying here that Bianca, on this date, let me change the color of my pen, November 5th, right here, paid for boilers that were bought here on October 10th. So this might seem like a simple transaction, but we have to remember that we have credit terms of 310 and 30. This means that if something is paid within 10 days, the individual would receive a 3% discount on the total sale. If we go from November 5th, right over here, to October 30th, we see that in fact it is less than 10 days. So Bianca will receive a discount. Now we need to go and see how that would be journalized. So on October 30th, Bianca bought 15 boilers. And we were told that each boiler is worth $10,000. This means that Bianca owed $150,000. However, because she paid before the date, she'll receive a discount, a sales discount, equal to 3%. So 3% of $150,000 is $4,000, $500, which she will not pay and will be deducted from trade receivables. So what we see here is that our journal entry would look something like this. On November 5th, they will receive cash of $145,000, which is equal to $150,000 of what was owed minus $4,500 because they paid on time. Next, there will be the sales discount. So I'm going to write sales discount of $4,500. And I'm going to make a small correction here. My mistake. It's right over here. We have $1,450. Same thing right over here. And I apologize for that small typo. For $500. Perfect. And this all comes from our trade receivables of $150,000, which is what Bianca owed us. So that is our first journal entry. I'm now going to move on to the next page to work on the second journal entry. So the second journal entry that we were asked for was journal entry F. So journal entry F reads as follows. Anthony Inc. returned 2 boilers and paid plus paid the amount due. So let's take a look at how many he had bought and how many he returned and how many he had yet to pay. More importantly, let's look at if this paid due was eligible for the discount. Eligible or not. So let's go back. So looking at our timeline, we see that Anthony, right over here, where are we? There we go. Have I forgotten one? November 15th. Yes, I'm sorry. See, this is what happens when you have a timeline. November 15th, we had returned 2 paid owed. And this is why a timeline is very, very important. So I apologize for that. So we see that on November 15th, he paid for something that was bought on November 1st. Now, that's 15 days past, November 15th to November 1st, which is more than 10 days, so he will not be eligible for the discount. So we don't have to worry about that. So we saw that Anthony Inc. had bought 12 boilers. Now we know that each boiler has a $10,000 price tag, So he owed $120,000. However, on this date of November 15th, he returned 2 times $10,000, which is equal to $20,000 that he no longer has to pay. And in this instance, there are 2 ways of going about our journal entries. So let's do option 1. So option 1 combines everything into one journal entry. So we see that what he owes now is $100,000. So we can say cash is paid of $100,000. However, there's a sales discount of $20,000. And this gives us our full amount of what was previously in our trade receivables of $120,000. However, we could have broken down this into 2 separate steps. We could have adjusted our sales and our trade receivables and then taken our cash. So we could have also said, well, we have a sales discount because they've returned them of $20,000. So that means that our trade receivables are actually overstated by $20,000. Now that we've taken this out, we can move forward with just a regular journal entry for what they owe us, $100,000, and our trade receivables of $100,000. Sorry about that, $100,000. Again, these 2 methods give us the exact same outcome in both instances. In the end, we have cash, $100,000, sales discount of $20,000, and trade receivables of $120,000, which is here and right here. So that is our second journal entry. Now let's move down and look at the third journal entry that we were asked for. On December 5th, H. So on December 5th, after a thorough review of its trade receivables, Pete determined that receivables totaling $12,000 were not collectible. This means that they wrote off $12,000 on that day from sales made prior to October 1st, 2011. So what this is a simple write-off. So we wrote off $12,000, which were uncollectible. If we journalize it, it would simply be December 5th, our allowance for doubtful accounts, $12,000, and our trade receivables for $12,000. And that's it for that journal entry. Finally, move on to I, our last journal entry, on December 30th. On December 30th, Pete recovered $3,000 from previous write-off. Now, this is a very common question, and we have to remember it's a 2-step journal entry. We have to reverse what was done when we did write it off, and then we have to take it from our trade receivables because it was received in cash. So, by reversing the journal entry, not for the total amount, but only the recollected amount, we have the following. On December 30th, we have our trade receivables, which go back up for the $12,000 that was recovered, and our allowance for doubtful accounts as well. Then, this was collected in cash for $12,000 and will no longer find itself in our trade receivables. And that is our full journal entry. So that is the end of requirement 1. Now we're back to look at requirement 2. So requirement 2 reads as follows, or asks as follows. So using this table of aging trade receivables, they want us to determine the amount of receivables that may not be collectible in the future. And their hint was to use a timeline. So we're going to use exactly what they said and alternate our timeline of what we'd already done. So let's take a look at what that looks like. So at October 1st, this is October 1st actually, okay. So let's say October 10th of our transaction. We were told that right over here, we had a beginning trade receivables of $60,000. So it's very important not to forget this amount, which hasn't been accounted for and was in our beginning balance. So before October 1st, we had $60,000. On October 10th, nothing happened. On October 30th, we sold 15 boilers for $150,000 to Bianca. On October 10th, sorry. Next, we move on to November 1st. On November 1st, we sold 12 $120,000 worth of boilers to Anthony Inc. On November 5th, we recovered $150,000, which were paid by Bianca. That's November 5th. On November 15th, we refunded $20,000 from our trade receivables and collected $100,000 in cash. On December 1st, we were paid $80,000 by Chang. On December 5th, we had to write off $12,000. And finally, on December 30th, we recovered $3,000, but then they were written off for $3,000. So what this timeline tells us, these are all impacts on trade receivables. And using this, we'll be able to use our table to see what's owed and when. So let's recreate our table. So our table looks as follows. We have the age group. We have trade receivables not yet due. We have 1 to 30 days past due. We have 31 to 60 past due. And then we have more than 60. All right. So right over here we have the amount receivable, then we have the percent, and we have our estimate of what we won't be able to receive. So in the age group, in the not yet due would be sales made from December 30th to 30 days back. As we saw, we had N30 terms. This means that all sales need to be made within 30 days of the sale. All payments, need to be made within 30 days of the sale. So if you look at December 30th, if we go back to December 1st, we see that we didn't sell anything since then. Nothing has been sold in this amount. So right over here, not yet due, we have 0. Next, we look at 1 to 30 days past due. Now this would be from December 1st to November 1st. And from December 1st to November 1st, we see that on November 7th, this is my mistake, we sold $100,000 to Cheng. And since then, Cheng has only paid $80,000. So we have right here $100,000 minus $80,000, totaling $20,000 still unpaid. Next, we look at 31 to 60 past days. So we look from November 1st to October 1st. And from November 1st to October 1st, we see there's $150,000, but that was paid right here. We see $120,000, but that was paid right here. So there is actually 0 outstanding. And finally, we look at payments that have yet to be made more than 60 days old. And this is one that often people forget, but it's very, very important to be aware of. So we were told that on October 10th, there was $60,000 that remained unpaid. However, on December 5th, we wrote 12 off. So this means that we had 60,000 minus 12,000, which gives us $48,000 of unpaid amounts. And these are what is owed. Now we use the percentages given to us in the problem of 5%, of 10%, and so forth. And by multiplying out, we're able to see how much we've yet to collect. 0, $2,000, 0, $9,600, and this totals $11,600. Now that we found our magical number here, we'll have to look at our allowance for doubtful accounts and see how this is affected at the end. So this tells us, and we now know, that our ending balance for our allowance for doubtful accounts is equal to $11,600. That is what we want it to get to. So now we calculate our bad debt expense for the year, looking at our allowance for doubtful accounts table. Alright, so let's look at this table. From the first beginning of the problem, so many pages going on, we were told right here that we had a credit balance of $15,000 in our allowance for doubtful accounts. So we can't forget that as our beginning balance, $15,000. Next, we were told that during the year, we wrote off $12,000. However, $3,000 were collected back. And that is everything that has happened to our accounts during the year. Now from here, we know that we want our ending balance to be $11,600, which means that we're missing something here. So our total of this column here, $15,000 minus $12,000 plus $3,000 plus X has to be equal to $11,600. So if we do a quick calculation, we see that, just 2 seconds, minus 12,000 plus 3,000, this equals $6,000. So 11,600 minus 6,000 is equal to our X, which gives us X equal to $5,600. Now using this, we can make our adjusting entry. Our bad debt expense will be equal to $5,600. We don't need this. And our allowance for doubtful accounts will also need to be credited $5,600. Doing this, we have the following T account. $15,000 beginning balance, $12,000 write-off, $3,000 recovery, and that is where we are now. We want to get to $11,600, and the missing number is $5,600, which we've already accounted for and we're able to find by solving backwards. Next, let's take a look at requirement number 3. So requirement number 3, going back, asks us the following. Assume for this part only that Pete uses the percentage of credit sales method to determine bad debt expense. Based on past experience, Pete estimated the bad debt rate to be 1% of net credit sales. Determine the amount of bad debt expense for 2011. A journal entry is not required. So what we want to do here is calculate our net sales and then take the percentage of credit from so. So if we go to our last page, we were told that our beginning balance of net sales was $600,000. Then we know that we made multiple sales during the year. $150,000 to Bianca, $120,000 to Anthony, $100,000 to Cheng. And then we need to subtract everything that were deducted from net sales, such as the $4,500 discount because Bianca paid on time, or the $20,000 that were returned from Anthony because they were not the boilers were not necessarily working properly. This brings us to a total net sales of $945,000. Now we were told that their bad debt expense is 1%. So we have $945,000 times 1% is equal to $9,455 of bad debt expense. and that is requirement number 3. So now that we've finished requirement 3, we're going to move on to requirement 4. So requirement 4 states the following. Pete's net trade receivables were $62,000 at December 31st, 2010. Calculate Pete's average collection period for the year of 2011 and explain what it means. Assume that Pete uses the aging of trade receivables method for this requirement, which is what we did in requirement 2. So let's take a look. So first we'll start with our formula. For requirement 4. We'll start with our formula of receivables turnover ratio. Receivables turnover ratio. This is equal to our net credit sales divided by our average net trade receivables. So this is both our beginning balance and our ending balance. So let's get to it. Let's start with our net credit sales. So our net credit sales we've actually just calculated. So if we move backwards just one page, we see that right over here we calculated our net credit sales. So we can just copy that number right away. $945,000. Next we have the beginning net trade receivables. And this was also given in the problem. So if we go all the way back here, we were told that Pete's net trade receivables were $62,000 at December 31st, 2010. So that we know and is given. Let's add that in there. And finally, we want the ending balance of our net trade receivables. And this one wasn't given, but we've indirectly calculated in one of the previous requirements. So when we were looking at our aging trade receivables, we used this table here. And what we saw was that we had $20,000 worth of trade receivables that were 1 to 30 days past due, and $48,000 worth of trade receivables that were more than 60 days due. What this means is that we have $68,000 of net trade receivables of trade receivables at the end of the year. And out of this 68,000, we have 11,600 that we're estimating will be uncollectible. So if we move back to our calculation, we had 68,000 of trade receivables outstanding, and out of that, 11,600 which we are not collecting expect. So if we add all of this into our formula, our ratio is equal to the following: $945,000 divided by 62,000 plus 68,000 minus 11,600, all of this divided by 2. And this brings our ratio to 15.97. Now, what we want to calculate is our average collection period. So our average collection period, average collection period, is equal to 365 divided by our ratio, which we found right here. So from this, we see 365 divided by 15.97, and this is equal to 22.9 days. We asked to explain. So what this means is that the average time for the average customer to pay the amount owed is 22.9 days, and that's what the ratio tells us, and that's how we explain it. So now that we've finished requirement 4, we'll move on to the final requirement, requirement 5, which is quite short. So it's asking us to evaluate Pete's average collection period, knowing that 2 major competitors, Spartans Corp. And Hosers Limited, reported an average collection period of 20.3 days and 30.7 days, respectively, for 2011. So 20.3 and 30.7. We'll brand a new page. So requirement 5. So when evaluating, we could say that they have 20.3 and 30.7. And we find ourselves currently at 22.9 days. So this means that we're doing better than one of our competitors, worse than one of our competitors, and better than the other. So these individuals are collecting faster, and these are taking longer to collect. But overall, we're in a pretty good standing. Another main takeaway is that, as we saw, our credit terms were N30. So this means that we're asking our customers to pay us within 30 days of their purchase. And on average, they're paying us 22.9 days in. So this means that they're actually respecting a lot of our credit terms, and we're doing well. And that is the end for question 4. Thank you.